everyone, my name is Concepcion with the student number of GBY2063 from Holmes Institute, Sydney campus. Today, I will be talking about my assignment in corporate accounting, which is accounting for income tax for my chosen company, which is Qantas. Firstly, I would like to give you an introduction of my assignment regarding Qantas. Established in 1920 in Queensland, Australia, Qantas Airways Limited is a well-known airline organization that provides a job and economic opportunity in Australia with more than 30,000 employees and economic contribution of 0.7 gross domestic products and more than $5.1 billion services offered to the country, especially in terms of trade and tourism. Qantas can boost their commitment in terms of tax payment. For instance, the Qantas Group paid around 4.07 billion taxes in 2019. The company believes that its tax treatment is well reported in its income statement, balance sheet, and other financial statements. Moving on, I would like to talk about the concepts of accounting profit, taxable profit, temporary difference, taxable temporary difference, deductive temporary difference, deferred tax assets, and deferred tax liability. Firstly, accounting profit. Accounting profit, this is the total income or earning of the company calculated based on the IFRS or GAAP, or simply total revenue minus total cost of explicit costs. For example, these are the payments made by the company in their purchases. The total comprehensive of Qantas is $528 million in 2019 and $138 million in 2018. Moving on, taxable profit. Taxable profit is gross income less deduction or exemption in the fiscal year payable to the government based on the 2019 annual report of the company to their tax or taxable income is 261 and in 2018 it is 269. Next is the temporary difference. Temporary difference is the of the company in 2019 were 97 and in 2018 it was 106. Moving on, I'll be talking about the deductive temporary difference. The deductive temporary difference, this is also a temporary difference that can be deducted in the future to determine the income or loss of the company, depending on the amount. Example, employee benefits or leave benefits. Next is the taxable temporary difference. Taxable temporary difference, this is the actual projected taxable amount in the future that can affect the income or loss of the company. Next is deferred tax assets and deferred tax liability. In the 2019 report, the company, the deferred tax liabilities is 847 million, while in 2018 the deferred tax liabilities is 810 million. It is the tax expense that is included in the profit or loss within the fiscal year. The deferred tax assets are assets like sales of the asset that can increase tax but not in the tax deduction. Moving on, I'm going to talk about the recognition of deferred tax assets and tax liability. The company recognition of deferred tax assets and deferred tax liability is based on the temporary difference of its carrying amount as indicated in the financial reports, and the amount identified will be used for taxation. However, deferred tax is unrecognized by different factors, including the temporary tax difference. Another factor that is not recognized is the temporary difference from the investment of controlled entities and opportunities. Moving on, income tax expense or income tax expense in the latest financial statement. The income tax expense is the identified expenses that the company recorded and recognized in the fiscal year. This is used for government tax identification accordingly to the profit of the company. The company income tax expense in 2019 is $374 million, while in 2018 it is $399 million. Moving on, I'm going to talk about the company tax rate times firm's accounting income. The company company tax expense times the firm's accounting tax rate is not the same as the firm's accounting income. If tax expense is equal to the tax rate times taxable income, then we can say that for 2019, the tax rate of 528 times 29.6% is equals to 156.29. While for 2018, it is 1,438 times 29.5% equals 424. The firm's accounting tax rate times the accounting income is lower into the tax expense in 2019. And number 5 is deferred tax asset liabilities. The identified deferred tax asset liabilities for Qantas for 2019 are 847, while for the previous year of 2018 it was 910. This was recorded for different factors such as for the reconciliation of receivables, inventories, plants and equipments, payables, receivables, and other tax income. It is also recorded to identify the company carried forward tax losses useful for referencing the previous and future recording. Moving on is number 6. It is income tax payable records of Qantas. Income tax payable record in the income tax expense for 2019 it is $113 million, while for 2018 it is only $7 million. This is highly different in the income tax expense in 2019, which is $374 million, while in 2018 it is $399 million, as recognized in the consolidated income statement. Moving on with number 7, I'm talking about the income tax expense and income tax paid. Income tax expense and income tax paid. The income for tax expense is included in the income statement, but the income tax paid is not included in the cash flow. The income tax paid was separated in another tax expense financial statement, and note that this is because the income of this group are payable less than 30% of the group's statutory profit. It is also stated that in 2019, temporary difference was recorded as $97 million, while in 2019, it was recorded as $106 million. This figure resulted in the difference taxable income and statutory profit before tax can be reversed in the next tax depreciation period. Moving on for number 8, we're talking about the concept of temporary difference and permanent difference. Temporary difference and permanent differences are deferred taxes and the different taxes recorded in the technical statements, and the tax may differ as recorded in the income statement. An example is rental income. The income tax expense of Qantas in 2019 is $374, while in 2018 is $399. While the income tax payable for 2019 was $113, and for 2018 it was only recorded as 7. However, no item was recorded in the income tax that has permanent differences that a company was recorded, but only temporary differences, including the group's statutory profit before tax and accelerated tax depreciation of aircraft. In number 9, we will be talking about the interesting, confusing, surprising, and difficult to understand the treatment of tax of Qantas Airways Limited. It says that the effective tax treatment of the company, including their honest disclosure of their accounts in their annual report, is also related to the most interesting features. The effective tax treatment of the company, including their honest disclosure of their accounts in their annual report, is also related to the most interesting features. When it comes to the interesting part, it's seen immediately in the very first few pages of the annual report in the financial highlight, and showcasing 1.3 billion underlying profit before tax and 1.27 billion statutory profit before tax. They are now giving 55 cents statutory earnings per share, which is better compared to the previous years, that they are giving flat shares less than 55 cents. Therefore, in my conclusion, based on the analysis of their annual report and financial statements, it is proven that the company is well managed in terms of tax payment and tax treatment. Their reports are found to include all the reliable and valid elements of honest and expenses, income tax adjustment, temporary differences, taxable income, and other related accounts are well reported in the income statement, balance sheet, and cash flow. There are notes and separate pages to understand what has been reported that makes it easier to researchers or inventors. Therefore, I conclude that the company is well managed because of good tax treatment, that the ability to pay helps the company to gain a good reputation and at the same time helps the government to also boost its GDP income. And that's end my presentation. Thank you.